So today I'm going to share with you two stocks that I have sold recently. I sold these last week. One of them was a complete sale, sold every single share I own. One of them was a 10% trim to take some profit off the table. One for 55% return positive and one for 30% return positive. And I think that's really important to be doing that right now. I've said it all the time, especially in this bear market. I want to be transparent, show you what I'm buying, show you what I'm selling, and where we're seeing a lot of other YouTubers now starting to disappear, maybe not share what they're buying and selling things out secretly in the background. I'm still here being transparent and showing you the moves that I'm making. So hopefully you enjoy the video, and I'll go through the reasons why I sold these stocks or trimmed one of these positions. And it's going to be quite funny to do this video because once again, we're going to see what's going to happen in the comment section, because 2 days ago I posted a video about Tattooed Chef, which was some of the negatives, and it was funny seeing all the negative people come out in that comment section. There was the most comments I've ever had for a long time having a go at me. I'm sure when I'm talking about selling some more stocks for even more profit, once again, add to the long list that we had on the whiteboard the other day, and that list didn't even have every stock on that we sold for profit. We're going to add another 2 onto that list that goes longer than the whiteboard. So we'll see if them negative people are going to be brave enough to pop up in the comment section this time, eh? I'm sure they're a little bit quieter today. But let's get stuck onto these stocks. And just so you know, there's currently a Black Friday sale going on the Patreon. So at the moment, if you sign up annually, you'll get 2 months for free. And on the Patreon, that's where I post what I'm buying and selling in real time. So you guys on Patreon know I made this move last week. And also I post 2 exclusive videos a week on there. So if you do want to join, link is in the description. All you have to do is join annually. As you see here, it says save 16%. I am only going to be running it for this week, and I don't plan to run it for a very long time again. And I am limiting it to down to just 100 places because it is a pretty good offer. And at the moment, I think there's 79 places left. So yeah, the spots are already being taken up in the first 24 hours it's been on offer. So yeah, I'll expect them all to be gone very soon. So the first stock is Celsius. So this is a stock that I sold for 10% of my position, or sold 10% of my position. I've sold some previously. I then added some more onto the pile of selling them. And the reason why I sold Celsius is there's 2 factors that come in here. So the first one is the valuation. This is a growth stock that has broken the trend. A lot of growth stocks are sitting at 52-week close or near 52-week close. Celsius isn't really doing that. It's currently sitting very close to its 52-week highs, and it is sitting at a bit of a rich valuation. So for example, if we have a look at the metrics right now, you'll see here it's at a price to sales ratio of 8, a enterprise value to EBITDA of 60, and a normalized earnings on a forward basis of 119. They're pretty high metrics right now, and you think, can those metrics double? I mean, you were talking near the peaks where we're at in February 2021, where we had the euphoria in the market. So that's the $1 million question, but it is growing pretty fast. We know Celsius is growing fast, and it won't take them long to drop their metrics either. And that's the other thing that I've got to weigh up, is the growth. Now, the thing that I have with the growth is, for Celsius to command this valuation, it needs to keep putting up mass amounts of growth that it is doing right now. And the big problem with Celsius that they have at the moment is they are now starting to become a mainstream player in the US. So I can easily see them putting up good amounts of growth in 2023, maybe moving into 2024. But then to keep justifying this valuation and to keep me potentially getting a double up again of the share price, let's say, I need this company to still offer good amounts of growth. And if you are saturating the US market now, you need to then move to an international business, which we covered on Celsius the other day. And at the moment, Celsius isn't developing their international business as much as what I was hoping for in the last 12 months. And I want to kind of see the kind of shoots. I want to see the seeds planted and now the shoots starting to grow. And I'm not seeing that. I saw the seeds planted and nothing grew from them. So what happened is, you can see on the international platform, this was growing at 100+%, and now it's really starting to slow down on the growth. And what happened as well is that we saw the launch into the UK side on Amazon, and potentially they were looking at some other countries in the EU. Now since then, there is no revenue now coming from the UK, and since then what they've been selling their products on, which is Amazon, Celsius have actually had their products taken off Amazon. Now, I don't know why this is, and I've actually emailed the investor relation team why this is happening. And unfortunately, I got no reply from the investor relation team. Now, my automatic thinking was, okay, they've had a partnership or an investment from Pepsi, and they're going to now use Pepsi as their distribution, and maybe it's just removing them from Amazon and then moving it to the Pepsi, and we'll see that popping up sometime soon, and Pepsi will sort them out for the EU international expansion. But I'm not seeing any response from the investor relation team. That was a few months ago. There was nothing mentioned that I found in the recent earnings, and obviously when I have the concern of and have contacted the investor relations team, I've got no reply. So me looking at the stock and thinking, okay, it's going to be still very good on the US side of it, but for the EU, I want to see now them starting to line up for good growth into the EU, because they need to have good growth in that area now to command the valuation. And because I'm not seeing that happen, and then there's a lack of communication from the management team, I thought it was best for me to take some capital off the table. And the thing is, what we've seen previously is when we have invest in management teams and investor relations teams that don't really communicate with their shareholders that well, we've seen how that can sometimes end up on some of these share prices when these cracks start to appear. So the longer probably from me, the more you see quarter after quarter now, every kind of earnings, and there's no information given about the EU expansion, you're probably going to see this more often for me, where I do start trimming the Celsius position, which is a little bit disappointing because I think it could be a major success in the, obviously in the US it already is, but into Europe. But I've got to start getting details about it, because that's going to be a key driver for the growth and profit if it wants to get on the lines of a Monster Energy in the next 2-3 years. We need to start seeing the things starting to get planted now for the growth, and we're not seeing it at the moment. With that little concern that I have, and it up, and the valuation it's at, and what I'm up 55% profit, I decided to trim the position. So that's the first one. The next one is Dropbox. So I didn't sell this company because it was overvalued. Although I don't think it's an undervalued company at the moment. You can see it's an 8 billion company, 20 times earnings. I've owned this one for a few years. I took a 30% profit from this stock. Now, when you look at the metrics, you'll see here, they're about historically average, in line with what they normally are at. So I don't think it's crazily overvalued, and I don't think it's undervalued, because this company, what I really love about Dropbox, it's a really steady company. I mean, just look, 7% revenue growth, 10% net income growth. It's been very steadily growing in the positive direction, and sometimes these stocks are really nice to own, and they're very steady stocks in your portfolio. And actually, when you look more on a profit point of view, which they've been focusing on a lot more than the revenue, you'll actually see they're actually a little bit lower historically on free cash flow at 9 times compared to 16, 17. You'll also be able to see here that total enterprise value, they're down at 9 when normally they've been a lower teen range. So it's probably a bit cheaper on the profit metrics, but overall it's not standout cheap. I'd say it's about fairly valued at the moment. And you know what, if Dropbox was to drop down into the $18 range, I'd actually probably consider picking some more shares up. Now, the reason why I sold my position in Dropbox is just that I looked at this stock, and it's a stock that I've held for a while, and it's been falling down the pecking order a little bit because I've not been adding to it. It's become a bit of a smaller position. It's one of those stocks that I've been weighing up and going, by the time I do all the research on it, go through the conference calls every year, keep on top of it, could I move that money into something else? Could I move the Dropbox money into maybe a stock that performs better than Dropbox? And I thought that was also something that played on my mind. I'm not anywhere close to buying Dropbox at the moment, where there's plenty of stocks out there that I can buy. And what I've also noticed about Dropbox over since owning the business is the revenue is slowing down more and more, and at the moment the forecast is for them to grow 5% next year. So the growth is slowing and slowing. And what do we know about Dropbox? Well, it's in the cloud storage space. What do we know about that space? Well, that was kind of a peak space through 2015 up to 2020, maybe 2021 as the CV situation happened. But now the cloud kind of potential is kind of peaking now at the moment, and you're seeing the growth slowing down. Sure, the profit's still good, and the thing is, I could easily see this going back to the sort of $30 levels back here at some point. But for me, it just weighed up to the kind of all these little combination of factors that kind of came in, and I thought, you know what, I'm just going to take this cash here, and I think there's other opportunities out there that I'd like to invest it into. I'll take my profit, and I'm going to say, I would like, now that Dropbox has come out of my portfolio, I would like to replace it with another stable, profitable company. I've been looking at a few stocks. I mean, the likes of B&M was actually quite an interesting one the other day, but that's a UK one. I would like to have a US kind of stock that is a very steady performing stock like Dropbox. Had a consideration at something like a Walgreens the other day, still a little bit unsure on that one, but I would like to replace it with something like that. But that's a topic for another day. The main thing, like I said, I want to say is that I don't think it's undervalued or overvalued. I just think right now there's better places that I can use that money, and I don't think it's going to be a crazy performer in the next few years when we're currently in the bear market, and I think there's quite a few opportunities out there that I could potentially take, and that's why I sold off the Dropbox, even though I'm still a bit of a fan of it, and if it goes to the right price, you probably see me buy back in anyway. So yeah, I hope you enjoyed the video, guys, and if you could hit that like button, and I'll see you in a bit.